Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today we are running through a introduction to what my strategy session looks like, what it feels like, and my overall strategy of buying 10 properties in 10 years. So without further ado, we shall kick it off. So the end goal in mind is to create a passive income. So this is either done by buying the 10 properties, allowing the rents to pay off the debt over a period of time, and then live off the rental income. So that can take a long period of time, 20, 30 years. So there's other strategies which I use, which is an equity release strategy. So rather than waiting 20, 30 years to enjoy the fruits of your labor, you can refinance the loans, draw equity, use that equity as discretionary, as well as reinvesting and keep growing your portfolio and keep growing your wealth. So that's what I do. I balance both the rental income, the high yields from the rental income, to balance the higher interest costs as I increase the debt levels as the portfolio grows, and then extract the equity to not just reinvest to keep growing the portfolio, but to enjoy the fruits of your labor. And really within 4 to 5, 6 years, you'll be able to enjoy the fruits of your labor. So, I mean, I say 10 properties in 10 years. That's a very conservative approach. Um, I mean, I've got to 17 properties now in 7 years. So depending how hard you want to push the envelope, it's all up to you. But ultimately, the end goal in mind is to create that passive income so you're not reliant on your job, your day job. You work because you want to work. You may want to change industries. You may want to take some time off, go on a holiday. When you have kids, you can spend more time with your family, kids, and spend more time with your friends, and ultimately give you more options in life. If you want to take a year or 2 or 3 off, you can release the equity, use that, and ultimately your portfolio will be the backbone of your lifestyle. So that's the luxury of building a portfolio, is freeing you up, and then after a while you'll realize it's not about the money, it's about getting your time back. So the only way to get your time back is by creating a passive income and freeing you from your day job, the rat race of being tied to your job. So that's the end goal in mind. That is what we build a portfolio for. It's not for status. It's not for, buying all the fancy cars and whatever. It's ultimately to create that passive income to allow you to have more freedom in your life. How this may ultimately look like 10 properties in 10 years is, as you said, we like to start with, this is from, if you're coming on board with us from scratch, this is what we'll set you up as your plan to do. So starting with a Sydney unit or a Melbourne unit or a Brisbane townhouse. Once you're into those metro markets, so Sydney, Melbourne, Brisbane, buy a couple of them. They'll have good growth, leverage the growth out of them into regional houses that have a better cash flow, that also have the ability to add value by way of development. So this can be a granny flat, this could be a subdivision to subdivide it, create a second title to build a second house, or you may even want to knock it down and build a block of units down the track. Leverage the growth out of the regional houses, and then buy your final trophy piece, such as a block of units, residential units. So we stick to residential. We build solid foundation portfolios, 10 properties, 10 years, very conservative time frame. So depending how hard you want to go, depending if you want to stick with the big 4 banks, or if you want to go to the tier 2 and tier 3 lenders, or if you want to open up a trust, you'll be able to get there a lot quicker, especially if you're on, 150, 200 grand. if you've got a 200 grand household income, well and truly smash it in, because we target these lower entry, blue collar, working class areas that have a high yield, low entry costs, and they have a good strong cash flow, so it allows you to keep growing and keep moving forward. So once you get to 10 properties in 10 years, it's up to you to continue to keep going, and that's what I'm doing. I'm building my portfolio. My goal is to hit 100 residential rental properties. They'll consist of individual units, townhouses, houses, blocks of units now. So I'm going to continue moving forward and keep building my portfolio. Eventually, once I get to about 50 to 100 residential, then I'll looking to get into the more commercial space. So buying shopping centers, pubs, hotels, that type of stuff. But not until I've well and truly got a solid foundation that can sail through the ups and downs of the GFCs, the 91 recession we had to have, the COVIDs, the dot-com bust. So the solid residential foundation portfolio will back you the whole way. Yes, it will have a lesser yield than commercial, but the vacancies are really only no more than a month. You know, there's some shop fronts and commercial spaces in inner Sydney. Like I live in Rod Point Five Dock area in the inner west in Sydney, and there's commercial spaces now that have been vacant for 2-3 years. So not getting into commercial too early. You need to have that solid foundation residential portfolio before getting into commercial. But that's an option. Keep moving forward and keep growing off the back of once you've got 10 properties, or you may want to sell the individual units, pay off some of the debt, consolidate a bit, have a lower your debt to value ratio, so then you're living off the rental income. Or you may want to sell some down to reinvest the capital gain into a family home. Or you may even just want to leverage the whole portfolio to buy the family home. So that's what my strategy is. Probably once I get to about 20 or 30 residential properties, I'll leverage the whole, well, not the whole, but probably 30, 40% of the portfolio. We're looking to buy a farm up at the, um, up, up probably an hour and a half north of Sydney as our forever home. So delayed gratification, build the portfolio first, set yourself up, build wealth, leverage the portfolio to then buy your dream place. And in the meantime, rent vest. So we rent in Sydney. The house is probably worth 3 to 3.5 million, and we're only paying $770 a week in rent. So very low yield. So we get to live in the desirable area, and we get to build our portfolio a lot more aggressively and build more wealth than going out and buying the family home too early, and then like being a big anchor on a boat and dragging you down and holding you back in terms of building wealth for a long period of time. So we advocate building your portfolio first, delay buying the family home, just like you don't go buy your Ferrari as your first car. You might run around in a shitbox secondhand car for many years until you get to a stage where buying the family home is not so much of a burden anymore. So you'll always be able to live too in a more desirable area if you rent the place you live in. So bit of a mindset change, bit of a concept change, bit of a strategy change for what most parents did if they got parents that are baby boomers who had that traditional strategy of saving up, buying the family home, flipping a couple of times and into a forever home. That is not so much achievable anymore, that strategy, especially if you want to live in somewhere like Sydney, Melbourne, or Brisbane in a metro market in a desirable area. You're going to need a couple of $1,000,000. So, and even if you could get that loan, most of your earned income would be going into that mortgage and paying the interest to the bank. So it'll tie you down and hold you back. So that's what 10 properties in 10 years would look like. You may be thinking, how the hell do you just go out and buy 10 properties in 10 years? You will need to use the equity release. So you have to obviously save up and buy the first one from scratch, but then once you've bought your first one, it increases in value. You refinance the loan, you increase the loan to 80% of the new value. The banks debit the balance into your account. You use that to then reinvest to keep moving forward and buying and building your portfolio. So it's basically using the same deposit closing cost to keep rolling from one to the next. And then also once it starts to grow and compound, and your portfolio, typically residential real estate increases in value 7 to 8% per year on average. So once you've built a solid $5-6 million portfolio, you can live off 1 or 2% equity and still be well behind how much growth that your portfolio will continue to gain over time. So who cares if you're using 1% discretionary and the growth is going at 7%, you're still well behind and in a solid, stable position. So that's what I do. I use a combination of both cash flow to allow the bank to keep lending me more money so I can keep growing, keep building, keeping the portfolio at that neutral to positive position, but ultimately using that equity to really enjoy the fruits of your labor early on and not have to wait until you're 50, 60 years old to use or enjoy the fruits of your labor. Also, using equity is tax-free, it's debt. Yes, you'll pay the interest to the bank at today's rate, 6-7%, but 6%, 7% cost is a lot cheaper than 45 cents in the dollar or 45% to the ATO. So equity play is definitely a very powerful strategy you may well want to look into. These are our main key fundamentals to buying a property to allow you to build that 10 plus property portfolio within a short period of time. So, 10 years. So the fundamentals, number one, buy the property for underbanked value and under rebuild costs. Underbanked value, we run RPDA reports and CommBank reports to see what the big four banks value them at. These same reports are used to give to people to go to an auction, say this is how much the property's worth, don't bid above this because we'll only give you 80% loan. We use those same reports, but we like to go the other way to build in equity from day one. So you can redraw that equity within 6 to 12 months to keep moving forward to buy your next property. Second to that is under rebuild costs. So I'm a value investor. I only invest for value. If I can see value, I'll buy. So under rebuild costs these days, it costs anywhere between 450 to 500,000 to build a unit, and it costs 700,000 plus to build a house. So we buy units between that 250 to 350 mark, or even high threes. 250 to high threes. Houses under 500. And then the same concept goes for when you're buying a block of units, but typically when you're buying a block, you can buy it in bulk, so you can get even better discounts. So recent block of units I've personally bought was 4 units in one block for 665,000. So that equated to 665 divided by 4, 166,000 a door. So $166,000 for one unit is a lot less than what it costs to rebuild it. That unit complex today costs at least 1.5 to build. So there's automatic equity in the deal from day one. So underbank value, under rebuild cost is a must. Otherwise, I just don't buy it. It'll be too overpriced. So steering away from new and off the plan, all that rubbish, will not allow you to build a sustainable portfolio, or even new greenfield house and land packages, all that stuff, rubbish. Anyone that's spruiking that stuff is getting paid by the developer to sell it off. So be very wary of that stuff. Only established properties is really where you can acquire a property for under bank value and under rebuild costs, because the person who's selling it is not looking at how much it costs to build it in the current climate. because they've probably held it for 30, 40 years. Number two, strong cash flow. At least 5% gross yield and ideally 6 to 7 and even 8s, depending on the asset, but minimum 5. We don't look at anything less than 5. Reason for that is it's like running a business. You need to keep the business profitable or at least breaking even, because otherwise the bank will stop lending you money. It's like taking $1 million loan out, going to the bank, taking $1 million loan out to start a business, and after year one, making a 30 grand loss if it's a yield of 1 or 2%. And then after year one, going back to the bank saying, hey, I'd like to borrow another 500,000 to reinvest and keep building this business. The banks don't do it. And not until your business grows and starts being profitable. So that same concept is related to property. So not until your portfolio increases its yields in terms of the rental yield, or your personal income increases, or your business, whatever income you're receiving increases, will then allow your servicing to grow. So having a 5% plus yield allows the income to service the holding costs relatively quickly, and ideally 6 to 7% pretty much straight away. So that allows the bank to keep lending you more money so you can keep growing, keep building. So we don't agree or believe negative gearing is a good strategy. Yes, you'll save a few $1,000s each year on tax, but you'll get locked up like 99% of investors who get themselves into property investment get stuck at 1 or 2 properties. If you want to join the 1%, if you want to build a portfolio of 6 to 10 plus properties, you will need a strong cash flow to allow you to keep in the game. Number 3, growing population. So this is either Sydney, a metro market, so Sydney, Melbourne, Brisbane, Perth, Adelaide, or a large regional hub will have a growing population. Number 4, so that growing population allows consistent demand to keep outstripping supply. So when more people keep coming, more people need housing, the demand keeps growing, there's less supply. Supply always lags behind demand. If there's always a growing demand, then you have capital growth. So not going out into, say, Broken Hill, where the population's been in decline for 30, 40 years, because if there's a declining population, there's less demand over time, you have next to no capital growth. You may have 2 or 3% growth, but that's just inflation. You won't actually have substantial growth. So growing population is a must. Number 4, in a suburb that will gentrify over time. So gentrification is the process of a suburb transitioning from a lower class to middle class, or a middle class to an upper class. It's transitioning the whole demographic of the area. That happens when there is public investment into an area, such as new roads, trains, light rails, tunnels, bridges, metros, new stations, where there's been a lack of historically. That public investment then spurs on private investors to come buy up sites, knock down old shitbox houses, build new blocks of apartments, duplex sites, make it. That draws people in, new people, new businesses start up, bougie restaurants, cafes, becomes a desirable area to live. That draws more money, more people with money, more well-off people. That then transitions the whole suburb from being an undesirable area to a desirable area. That is gentrification in a nutshell. So classic examples of gentrification in Sydney: Surrey Hills, Redfern, Balmain. Back in the 80s, late 80s, early 90s, you could have picked up terrace homes in Redfern for the 100 to 150,000 mark. These days, those same terraces are going for 3 to 4, 5 million bucks. So the extreme growth within a short period of time, well, 30-year, 40-year period of time, is because of gentrification. It is no longer a rough neck of the woods like Balmain used to be rough back in the day. They're very desirable areas, and they've gentrified over time. Another way, gentrification happens is the government sells off public housing to raise cash, pay down debt, to reinvest into other suburbs to build more housing. So when they're selling off high concentrated pockets in certain suburbs, that then spurs on private investment to come in, and then that then increases the gentrification wealth effect of the suburb. So we look at that. That is really how you can supercharge your growth as well. Number 5 is having a good balance of both capital growth and cash flow. So you'll see, if you're listen to a lot of, I guess, property investors out there, some people say capital growth, some people are cash flow. The reality is you need both. You need the capital growth to allow you to leverage the growth from one deal into the next, but you need the cash flow to allow you to stay in the game by way of allowing the bank to keep lending you more money. So don't go and buy out um, a 1 or 2 bedroom unit in Vaucluse, Bondi, Tamarama that's supposed blue chip. What is blue chip? But with a 1 or 2% yield, yes, you'll have the capital growth, but you'll have next to no cash flow. You'll be negative geared. And then the banks will stop lending you money relatively quickly. And then you'll be stuck for many years until either your rental income increases, which can take years, or your personal income, your wage, or your business. On the other side of the coin, don't go out and buy a house in Broken Hill that has a yield of 15%, because the population's in decline and you have next to no growth. So not chasing cash flow, not chasing capital growth, but you need a combination of both. So a good balance is between that, having those units or townhouses in a metro market, the houses in in a large regional hub, blocks of units in large regional hubs, or even in metro markets that have both good, strong population growth, good demand. You have that growth. And then you also have the cash flow from at least 5% gross yield to allow you to keep in the game. So good balance of both, not chasing either one, to allow you to keep growing and compounding and moving forward. So another way I like to visualize it is, it's like when you build your portfolio, it's like building a campfire. You need to start small with the kindling, and then gradually over time load the fire up with larger pieces of timber, split wood, to then ultimately put a large log on to let it burn all night. You don't go out and start loading your fire up with big pieces of timber and a log before the fire and the coals can sustain that, because you'll be on your hands and knees for the rest of your life blowing and trying to get your fire going. It's the same concept with property investment. Don't go out and buy the $2-3 million house straight off the bat, because you'll be forever tied to that for the rest of your life, paying it off, and you'll be a slave to the bank. Rather, start small. Even if the bank can lend you $1 million, $2 million, doesn't necessarily mean you should go and put that into one residential asset straight off the bat, or commercial for that matter. You should start small, diversify across multiple regions and markets, and then gradually load the fire up with larger assets to allow each deal to keep servicing themselves, and then they can keep funding future deals down the line to then ultimately build your campfire so it's sustainable for the long term. So starting off with a couple of units and townhouses, then a couple of houses that you can be added value by development, so granny flat or subdivision, or knock down and rebuild block of units on it. Don't have to do it straight away, but a couple of units in the metro markets, a few houses in the regions, and then a block of units. At that point, you've got a well-structured, sustainable portfolio, just like a well-structured, sustainable campfire. At that point, that's when you can look at loading it up for which way you wish to go, whether it's going and buying the fancy car or the fancy house or whatever. But build your wealth first, build your campfire first, because your campfire will serve you and your family a lifetime. One fancy family home won't, especially if you leverage up to your eyeballs. It only takes a couple of years of higher interest rates, and then next minute we go through the next GFC-like event. Unemployment will go through the roof to 10, 11, 12, 15%. So when rates are high and there's unemployment high, you might lose your job, then you might not be able to hold on to that big fancy house. So building the portfolio to making it sustainable so it can pay for itself and fund your lifestyle is the way, I believe, is the best way to go. We then touch on the 18-year land cycle. I use the 18-year land cycle as a framework to work out what metro market to invest in, how to manage my debt levels, cash levels, stocks, everything. So the 18-year land cycle consists of 14 years up of expansion, 4 years of downturn, and the 14 years of expansion is interrupted with a mid-cycle slowdown. In the mid-cycle slowdown, typically the stock markets around the world take a 30 to 50% correction, like what we saw in COVID. Property takes a 5 to 10% slowdown, not as significant. In the land-driven downturn, the stock market can take up to 60, even 70% decline. Commercial property can take up to 70 to 80% decline in values, as commercial assets are valued based off their earnings. And if the business goes broke and it's vacant for 3 to 4 years, it's only worth land value. So commercial can get absolutely slaughtered as well. Residential real estate can come off the boil 20 to 30% as well in the markets that have had the significant growth leading up to the peak of the market. So Brisbane, Perth, Adelaide typically lead the second half. The first half of the cycle, Sydney, Melbourne leads, as what we saw in 2012 to 2019, out of the recovery of the previous cycle. They reach a certain point where they're outstripping the affordability of the wage, and the rents top out. Then they stagnate for 10 to 12 years, while people then decentralize into Brisbane, Perth, Adelaide, and then they take off. So we like to invest counter-cyclical. We're now investing in Sydney, Melbourne, regional New South Wales, and regional Victoria in preparation for their next growth cycle, which will commence around 2028 and onwards, based off history. So we don't get carried away with the herd mainstream who are now ploughing into Brisbane, Perth, Adelaide, because you only put yourself in a position where there's more risk to the downside. As property typically stagnates for a 10-year period, 10 to 12, and then it goes through a 3 to 5 to 7 year growth expansion where it doubles or goes up 150%, tops out, may cool off a bit, 20%, and then we'll go through another protracted 10 to 12 year period. So we're finding pockets in Sydney and Melbourne and regional New South Wales and Victoria that have been stagnating for up to nearly 9 years. So it's only a matter of when, not if, they'll commence their next significant growth cycle, which I believe will commence in 2028 onwards. So we're now sowing our seeds in those regions and raising cash by refinancing loans. Well, personally, I'm refinancing my loans out of Queensland because they've had significant growth since 2022 and onwards, and we'll continue to do so, and then reinvest the capital into markets that have been suppressed for longer periods of time. So this framework I use in the strategy session to work out what, if someone's starting from scratch, where they should go, or if they've already got property, how to well diversify the portfolio, because you don't want to be just targeting one location, not just because of a land cycle perspective, but also policies from government. Sometimes, like right now, what we're seeing down in Melbourne and Victoria, they've got a $50,000 land tax threshold. So that is hurting investors to me, that's an opportunity. So the values are there now. So we're buying up there, but that's unsustainable. It'll only take a Liberal government to come in and wipe that. That's when it'll pop. So each state has their own laws and legislations and legislation around tenancy laws. So down in Melbourne, it's very favourable to, and Victoria, very favourable to the tenants versus compared to Brisbane or Queensland and New South Wales. New South Wales is sort of heading that way to being more favourable to the tenants. So it's balancing the risks of policy as well across multiple states. So you don't want to be piled into one area such as Sydney, because if Sydney has a policy change or a downturn, then you got all your eggs in one basket. So having a good, well diversified portfolio is key to making sure your property portfolio can be sustainable for the long term. So 18-year land cycle is very valuable. Can't stress that enough of how valuable this is. This has by far made me the most money than doing any cosmetic renovation or anything like that. It's understanding this land cycle, which is timing of when to acquire which asset in which location. Off the back of that, I mean, this is how I see the market currently in 2024. So not each state, region, major city or suburb run at the same pace. They all run different times of the cycle. The best time to buy property is between negative media and rising rents towards the bottom end of the cycle. So typically the market will peak out, it will cool off, then there'll be negative media, all the mainstream will jump on board. Then there's low competition because most people are scared to invest in those areas. That's when you can get good deals because you can negotiate hard on property. Nothing goes to auction. Hits the bottom of the market, flattens out for a good 5-6 years, next to no growth. That's when I really like to buy. Low competition, bottom of the market, before the rents start to rise even. Because once rents start to rise, that's catches on, everyone catches on, then it becomes more competitive and you can't get as good deals. So buying when it's low competition, bottom of the market, where it doesn't make sense to the mainstream, but it makes sense to, I guess, to me, you can negotiate really hard because they sit on the market for months and then rents rise, the rents get capitalized into higher prices, and then prices start rising. And then FOMO, every man his dog thinks they're missing out, so they all start charging in. It's all over National 9 News that Perth, Adelaide, Brisbane are going through gangbusters. That's when most people start to plow in, market tops out, and then it cools off. And most people who buy in now onwards until the peak of the market in 2026 in Perth, Adelaide, and Brisbane will overpay because you have to overpay now. Pretty much, you can't get under bank value or can't get under rebuild costs because the market is moving so quickly. Everything's selling within a week or a couple of days. And then they overpay, or they might even buy new off the plan, which is even worse. And developers then start looking at the markets that are booming, like Perth, Brisbane, Adelaide. I mean, recently I saw that there's a the tallest building in Adelaide's going up. So once developers start adding new stock onto the market, when it goes through its price rise, FOMO, peak in the market, because that's when it starts stacking up to start developing again. That's when developers start to build. They adding more stock, and then once the market tops out and they start selling off all these new stock, that then suppresses the market because there's an oversupply of property and a lack of demand, especially once the market starts to cool off and go through negative media. So counter-cyclical investing. You want to be greedy when others are fearful and fearful when others are greedy. Right now, everyone is greedy over Perth, Brisbane, Adelaide, and we're not even buying there anymore. We're mainly focusing on or really only focusing on Sydney, Melbourne, regional Victoria, regional New South Wales for the next, I'd say, decade until I see value again in Brisbane, Perth, and Adelaide to capitalize on their next growth cycle. Hope you all enjoyed that, and I hope that resonates. Just a disclaimer, this content is general in nature and by no means personal or general advice. Prior to making any investment decision, you should obtain independent legal, financial, investment, tax advice before buying a property. So I operate as a buyer's agent though. If this resonates with you, if you need help buying an investment grade property, I can help you. Help you get to 10 properties in 10 years. You don't need to be on a big income. People even on 70 to 80 grand, household income of 150, 200 grand, you'll easily get there within 10 years. And if you are on a larger income, then less than 5, depending how hard you want to go. It's all up to you. Hit me up anytime to chat. I'll put my details in the comments below. Happy to chat your position, where you're at, what your goals are, what you're trying to do. As always, take action. The only thing I can guarantee is if you don't take action, you will not get anywhere and you'll only fall behind, especially with inflation running so hot. If you think this content is valuable to anyone that you know, please share it. Like, subscribe, comment, do whatever you got to do. Unlike, like, dislike. Till next time, thank you for watching.